We're going to take a few classes here to talk about the relative value analysis. If you've had me before, you've seen some of this presentation, but I'll go in a little more detail because there's actually more that you need. And then this class, probably more next Tuesday, next Thursday, I'm going to show you exactly what you'll be working on. Next week should be my best week to go out and actually get these files updated so you'll have access to them. So I'll walk through, especially Tuesday night, I'll walk through exactly what I'm looking for. So let's tonight just establish what relative value is, and then specifically for your companies, what you'll need to do. There's three parts to this part of the paper 8. One is a ranking model where you're going to take your company, take its fundamentals, and rank it against its industry and try to figure out if your firm's overvalued, undervalued using relative value analysis. We'll talk about tonight. The second one is just looking at relative value over time and just getting a sense of what's normal, where they are they expensive, cheap to the industry. I've got a file that sets that up, and it's a very easy file to use, and I'll update it for all of your companies and send it to you. And you'll see most of the more recent papers, students of the example student papers, they use the files, the graphs from that second file. And then the last thing is the last valuation that you do, and I'll show you that one. It's really quite simple, and it's built into the file you already have. So I'll show you how to do that. Let's get into first what relative value is. I don't know what your background is on relative value. I know, Victor, you had my class. Curtis, I don't know if you had my investment class. Curtis, I can't remember. Alexander, I can't remember. So some of y'all may have seen this before, but I don't know how much of it you remember. So we'll see. For those who haven't had me before, you have to just let this be a good test to see how much you know about relative value analysis. So what I want to do is walk you through this to understand the concept, but as we go, I'm going to be emphasizing how I want you to do it differently in this class than I've done in my other classes, because you have to do a whole paper on this. So we'll start off real simply, just what is relative value? What does it actually mean in the context of other things we've been doing in this class? I'll give you an example from real estate. Some of y'all have seen this example before, but it's a good way. We do relative value analysis in real estate quite naturally. It's the most obvious thing that we do. We do it with stocks as well. It just looks different. Then the components of good relative value analysis. So I'm actually going to be building those components into the file I'm going to give you, which is unfortunate. It'd be a lot better if you could build this yourself so you could really see that you understand it. So I really encourage you to go back when you get a chance. Maybe next spring we have access to the Bloomberg room, and actually try to build this thing yourself. We have plenty of YouTubes that show you how to do it. So if you've never done something like this before, boy, I would make sure you get on your resume. It's not that complicated. You can teach yourself. In fact, we had a student who was in, I think, an engineering major. He never had a finance class in his life. He signed up to be a senior analyst for the Investment Society. And he asked me to help him because he'd never done this before. I came in to help him, and he'd already built his model off of our YouTubes. So even though he never had a finance class before, he at least figured out, he may not have understood all the data, but he at least figured out how to bring it in. And he did that, I think, in under an hour. So you really can teach yourself. It looks really impressive when you do this because it's so much data, but the actual analysis itself is not that difficult. So you got something that looks really impressive on your resume and something you put on LinkedIn that really is not that difficult to do. We'll talk about the most common relatives, but at that point, I really want to tie it back to your companies. I should have listed out your companies. I think I'm remembering most of them. And so which price relatives should you use for your particular company? I'm probably in the, when I build a file, I'm probably going to load all of the price relatives and let the regression analysis actually pick which one's the best one. But there are certain ones you would expect to be tied to your company. And then putting it all together is exactly what we want to do, is build something so we can actually do this analysis. So where does this fit in with what we've talked about? So papers 5 and 6 were really papers 3, 4, 5, and 6. You're doing fundamental analysis. You're looking at your company, you're assessing their history, you're looking at their financials, you're forecasting them. And then in papers 5 and 6, you're assessing the risk and you're doing a discounted cash flow and you're valuing the company. That's all fundamental analysis. That's what we teach in college, especially undergraduate. That's what we assume everybody's going to be doing. The next one is technical analysis. You'll be doing technical analysis in paper 9, although we're going to really pull back on it this semester since you don't have access to Bloomberg. But technical analysis, we'll talk about that later in the semester. The technical analysis is not that difficult to do with what we want to do. I just want you to really just get some practice with it. But what we want to talk about is relative value analysis. So you can do that. You can do that for both an asset strategy or a security analysis. You can use it to figure out if you want to be in large cap stocks, European stocks, emerging market stocks. You can also use relative value analysis to figure out which particular stocks you want to buy. So what you're going to do is this relative value analysis is to figure out if your stock is a good buy or not by comparing it on a relative basis to all the other stocks. And probably what I'll do is I'm going to bring in a very large group of stocks. So if you've got Exxon or Chevron or Valero, I'm going to bring in all the energy stocks. If you have Whirlpool or Starbucks, I'm going to bring in all of the consumer discretionary stocks. So it's going to be a huge list. Could be 300, 400 stocks. There are some places I might get real specific. So NVIDIA and Texas Instruments, I'll probably only have semiconductors against them. So there are places, and I'll have to experiment sometimes you need to, I'm sorry? Oh, sorry, Fernanda, can you come back in? I actually hit the button to mute you. Fernanda, can you unmute yours? I don't know how to do that. Okay. All right. Did you have a question, Fernanda?
No.
Okay.
No.
Okay. Sorry. I thought someone asked the question. All right. Maybe I missed it. All right. Okay. So we're going to be doing relative value analysis. Now, I thought it was interesting. Dr. Damodaran, when he's talking about relative value analysis, he said several years ago, he asked his students, his graduate students, New York Stern School of Business, which of these are you going to use? And they all said, well, we're going to all do fundamental analysis. 100%, because colleges are very negative on technical analysis, very negative on relative value analysis. And so he got curious, is this really true? Are they all doing papers 3, 4, 5, and 6, and 7, 3 through 7? And so he went out and he found his students 5 years later, and he did a survey. Now, I don't believe this survey because my own experience is not quite as skewed, but he said, based on his survey, 100% were doing relative value analysis and 0% were doing fundamental analysis. I just don't believe that. I did fundamental analysis when I was a security analyst. I'm pretty sure people do, but it is definitely skewed. I don't know anyone that just does fundamental analysis and doesn't do any relative analysis. There are people who don't do technical analysis, but at UTSA, we did all three and all the time. So it was pretty common to do all three. So he finally threw in the towel and said, okay, I've got to teach relative value analysis because everybody's doing it, but I'm at least going to teach it correctly. So he at least, and it was a really good presentation. It's going to be very similar to what I'm doing here. I actually stole a little bit of his stuff here just because it's, there's a few of the points he made that I thought were really, really good. So what is relative value analysis? You're taking some measure of value. So you only have two choices for stocks. It's either price or enterprise value. So you pick one of those two. I'll be using both of those in the analysis I'm going to build for you. You're going to take that valuation and compare it to some fundamental factor like earnings, like book value, like revenue. So what we're going to try to do is see if that relative, how it looks to other companies of similar characteristics. And that's the toughest part. It's finding companies of similar characteristics. So remember, when you do consumer staples, I'm going to throw every consumer staple in there. So everybody's doing Costco, you're going to have every company in there, every consumer staple company in there. So it's going to be a list of companies that really aren't similar. But if we bring in enough fundamental factors, we can get them similar enough. And so that's really the key. In fact, that's something Dr. Damodaran says. If you bring in all the right factors, you can compare Walmart to Alphabet, or you can compare Walgreens to Delta Airlines, as long as you bring in the right factors. All right, so here's the two measures: price, enterprise value. Price is just the price of the stock. That's pretty simple. Enterprise value gets a little tricky. Enterprise value is essentially the market value of the stock, of the equity, plus debt minus cash. And so for firms like Apple, who have a lot of debt, but they also have a lot of cash, essentially the price, enterprise value are exactly the same. There's no difference. They may have $200 billion in debt. They also have $200 billion in cash, and so those offset. So there actually was a time where Apple's enterprise value was less than their market value, less than the price, because they had so much cash. And so you subtracted that out. So that's a little bit of a challenge, but we're still going to go with it. The fundamental values can be just about anything, but the most common are earnings, revenue, and book value. There are industry-specific ones. The most common one I hear of is with utilities. We had someone from the utility industry speak to this class, and I asked him what factor to use, and for him it was enterprise value to regulatory assets. So for utility, they have a very specific type of asset that they use. But generally earnings related, we'll look at different measures of earnings, revenue, and book value. Those are the most common ones that we're going to use. Relative valuation doesn't actually value anything. All it does is says, let's assume the entire stock market's well valued. Let's just ask on a relative value, is any particular asset or security mispriced relative to all the others? And that's why in paper 8, you want to use the terms rich and cheap. Get comfortable with using those terms. They're not good terms. I don't know who came up with them. They're the terms that won. Whatever the history was of those two terms, those are the two that stuck. Cheap doesn't mean cheap, and as far as it's shoddily made or whatever. Cheap just means it's inexpensive, an inexpensive stock. Rich just means it's an expensive stock. So I actually would have preferred inexpensive, or relatively inexpensive, relatively expensive. You may have also heard of value stocks and growth stocks. There's some relationship here where value stocks tend to be cheap and growth stocks tend to be rich. So let's do the real estate example real quickly. Most of y'all understand this. So let's say you're going to buy a house in a neighborhood. All you know is the asking price, and it's $150,000. Well, obviously, you're not going to buy that. And I've had students on their papers talk about the price of a stock. I've heard some students say, "Wow, this stock's trading for $800. It's an expensive stock." Well, that means nothing. You know, if they did a stock split, the stock would go to $400. So the actual price of the stock doesn't tell you anything. And here the price of the house doesn't tell you anything. It's like relative to what? So you can't buy it yet. So what else would you like? Well, let's put a price relative in there. And let's just do it on price. So the price of the house is $50,000. But prices of other houses sold in the same neighborhood for $875 and $675. So now you know, wow, this house is cheap relative to 2 other houses, but it could be cheap for reasons. So we really don't know. So houses are a little different than stocks. A $150,000 house is a $150,000 house, but a stock trading for $100, that $100 doesn't tell you anything. They could do a stock split, a 4-to-1, just like Apple did, a 5-to-1 stock split. You go from $500 to $100. So that the stock price itself is a pretty random, unimportant number. You never want to say stock's expensive just because it has a high price. But with houses, we can't do that. We can't split the house up into 2 pieces and that kind of thing. So at least these are comparable. 150,000 is comparable because they're houses in the same neighborhood. But you still don't have enough information. You just know this house is cheap, but you don't know why. So now we'll do a true price relative, and we'll do price per square foot. And price per square foot is a price relative. You're taking the value of the house and divided by some fundamental value, and here it's square feet. So this house is trading for 75 bucks per square foot. Other houses that have been sold recently traded for 250 and 225. So you now know, wow, this house is trading pretty cheap. On a square foot basis, this house is cheap. Now, some people stop there. And if you stop here, you're going to end up with nothing but a bunch of value stocks. You're going to be buying JCPenney and Macy's and Sears or whatever, you know, just really stocks that are just having terrible trouble. So, you know, there's got to be some reason why that's trading so cheap. So that's what you have to do in paper 8. Say, okay, my stock is trading rich or cheap. So that's one of the things you're actually going to do. But then you're going to do an analysis and ask, well, why is it trading rich or cheap? Is there a reason for it? One of the reasons that in the market, we don't usually start with that as our first assumption. There's usually some other reason. But we want to ask, why is it trading so cheap? So what we're going to do is we're going to do exactly what you're going to do on paper 8. And this is what I'm going to do for you. You're going to bring in a bunch of factors. I'm going to bring in a bunch of factors. And you're going to use those factors to try to figure out what should the price relative for your company be. Now, for a house, we're going to do things like the size of the house. Does it have a pool? When was it painted? How good is the roof? How good are the fences? That kind of thing. And there's probably a dozen other things I left off here. So you want something related to value and something related to risk. The exact same thing we're going to do in paper 8. I'm going to bring in a bunch of fundamental factors, very similar, very, very similar to what you did on paper 4. Gross margin, net margin, asset turnover, return on equity, enterprise value added, all those kind of things that relate to the value of the house. I'm going to bring those in. I'm going to bring in risk factors, the debt of the firm, debt to EBITDA, the net working capital requirements. Sometimes I bring that in. It's a little bit tough to bring in. We could do the credit ratings of the firm. We'll probably use the Bloomberg score for that. But anything related to risk. So you bring those 2 factors in. If you leave one of these factors out, if you don't have factors related to value, then you're just going to end up with a bunch of high-risk companies. And that's why they're trading so cheap. If you leave risk out, you're just going to end up with a bunch of high-risk companies as well. So you got to have both of these in there. I mean, if you leave out risk, you can have firms with really bad fundamentals. I said that backwards. But so you need something on risk, something on fundamentals. Otherwise, you end up with a company that's really skewed. So if we could explain with those factors, have an R squared. So we could explain 91% of the volatility between the different prices of 350 houses over the last 3 years using that model. And using that model, we get a price per square foot of this house of $150 versus the 75, what we can currently buy for it. Now you're much more interested in buying the house. It's still trading really cheap. And this is essentially what we're going to do in paper 8. So we're going to figure out where should your company be trading versus where is it trading. And then you're going to make a decision whether or not this is a strong buy or a strong sell. So we're going to be doing exactly that with your company. Now, 91, could we get better than 91% R squared? Let's say we 2 factors in here. And has anything horrible happened in this house? Someone's been murdered in the house and now it's considered to be haunted. And when you do that, the value of the house drops all the way down to 80 bucks. So obviously something really bad has happened in this house. Maybe it hit the news. Maybe that's the reason people don't want to buy it. Well, that's pretty critical because you may not care about these 2 items. You may not care if someone's been murdered in the house. You may not believe houses are ever haunted. For you, you're getting a $150 house for 80 bucks per square foot, right? If you leave out those last 2 factors you don't care about, it's worth 150. But if you put them in, it's worth 80. If you don't care about them, you're getting a great deal. You're buying, you're buying a $150 house per square feet for 75. I might have said 80, but for 75, you're getting a 50% deduction on your price. So should you do it? That's the same thing you can see on paper 8. I may bring in some factors that are real important to the value of the house, but you might think that they're not important. And so we'll talk about when we look at the model, what you might do with those factors that you don't think are important. The key here is if you don't care about those things and you're going to live in that house for the next 20 years, I would buy it. You can buy it for 75. It's worth 150. You're getting a great deal. If the house really isn't haunted, you'll never notice that. And what do you care? what happened to the house before you owned it, you got a great deal. If you need to sell the house within the next 2 years, now you care. Because the next person going to buy the house from you is probably going to take those two things into account. And you may only be able to get $80 per square foot. For a house, you're paying $75. And so then it's not worth it. So that's one of the things you have to work on. So if you find that when we run these models, there's something going on in the market that you don't think is important, but it's for some reason important to the valuation of this firm, you have to assess what that means to you. And I'll show you how you can actually adjust for that, just to make sure. I'm actually going to run, I don't know how long it's going to take me. It might take me 30 hours to get this set up. I'm actually going to run the models and make sure they work before I get them to you. After I run them, I'm going to undo what I do. So you have to do it yourself, and I'll show you how to do that. But yeah, we're going to bring in a lot of factors. So relative value analysis ignores whether the entire housing market is overvalued or undervalued. It really doesn't, it's hard to do that. It's really hard to value a residential house. You can do it in terms of savings on rent. You say, instead of buying this house, I'll be living in an apartment, and you could try to value it that way, but it doesn't work all that well to do it that way. So it's really hard to know what is a house really, really worth. So the housing market is almost entirely on a relative value basis. It's just about the only way to do it. So if you think the whole housing market's overvalued, then you probably just don't buy a house and stay in an apartment, wait for the housing market to crash. The unfortunate thing with that is if the housing market's overvalued, then apartment rents are probably really high too. So there's a relationship between those two. So this analogy doesn't work perfectly with stocks, but there's quite a bit of overlap. So what you're asking in the housing market is, this house I'm considering buying reasonably priced versus other houses with the same attributions as my house. How's it trading once I adjust for all of those attributions, whether it's value or risk-related fundamental or risk-related factors? So you need to make sure you have fundamental factors in there, risk factors. You will have some. I'm going to build it both generic to the industry, and I'm going to try to bring some specific industry data. So if you're in an industry where research and development is really important, I'll probably bring that in. So for all the retail stocks, gross margin, I'll definitely bring that in. For the airlines industry, with Shamir, with Delta, we actually have an airline model already built. And probably all I'm going to do with that is just bring in more airlines besides just US airlines, so we get a little bit more to work with. But airlines is one I might do specifically. Lockheed, I might only do aerospace for Lockheed. So, there's some places with industries, no one's doing pharmaceuticals, so I'd probably do pharmaceuticals as their own thing. And in those, I'd use more industry-specific information. All right, so that's what we're after. So we're essentially, what we're going to do is we're going to use the fundamental values and the risk factors to try to predict what your firm's price relatives should be. And I'll give you some examples. We'll be doing a lot of examples, especially next Tuesday's class. So view your fundamental and risk factors as your independent variables and your price relative as your dependent variable. Higher fundamentals should mean higher relative values. So firms with higher gross margins, higher net margins, higher turnover, they should have higher relative values. Firms with higher risk, so higher debt, higher probabilities of default, lower credit ratings, that should mean lower relative values. So that's the way it should be. One thing I've definitely noticed in the last few years is the market seems to be ignoring risk factors. It seems to not care that firms have a lot of debt, and that kind of bothers me that would be the case, but I've seen it. I was actually talking to a portfolio manager a few years ago saying, what's going on? Why is the market not caring about risk at all and so focused on other things? So we'll see if that's still the case. As I build a model, it kind of changes. Maybe after COVID-19, it has changed somewhat. So we'll see. COVID-19 might actually mess up some of this analysis. And we'll just have to see if I can actually get a decent model for some of your industries. All right, so that's what we're after. Now, what the Investment Society does now is, I was watching a video from Dr. Damodaran, and he did a regression analysis similar to this. And I remember doing something similar to that when I was a security analyst and thinking, wow, we have the Bloomberg machines now. We had just gotten them. I thought, why don't we start doing this in our classes, especially in security analysis class and the investment society? And he did a regression analysis. The one he did in his class worked really, really well. He got really good factors, really good slopes, really good R squares. And so we started doing that. But what we discovered really quickly is regression models take forever because you always get bad data. And so we've switched from regression models into ranking models. And I'll show you why we use ranking models. I think you'll see it real quickly when we do the analysis. So it's not quite the independent and dependent variable. It's more of weight these factors in a way that we get the highest explanatory power we can for the actual price relatives. And this will make more sense as we do an example. All right, this is an extremely important page. Hopefully everybody's with me on this page because this is probably the most missed thing on paper 8. So make sure you're with me on this. So y'all remember this formula from paper 7, the dividend discount model. The price of the stock equals dividends divided by KE over G. Basic formula. Let's take the KE and let's break it out through the 3 pieces: risk-free rate, beta, and market risk premium. The G stays the same. And let's change dividend. Instead of using dividend, let's replace it with earnings per share times the payout ratio, right? The payout ratio times earnings per share is your dividend. So we'll break those two out together. So how do we take this formula, price equals all of that, and how do we make a PE ratio out of it? Well, just divide both sides by earnings, and that gives you the PE ratio equals all of this. I actually encourage students to have this formula in their wallet if they can't remember it, and take it with them because this formula explains a lot about finance and stock valuation. So the PE ratio of a stock is the payout ratio divided by the risk-free rate plus beta times the market risk premium times minus growth. That's it. That's what a PE ratio is. You could also do this with the price to book ratio and with the EV, the revenue ratio. I just don't have those formulas with me. We don't really need it. You're only going to use this formula in paper 8. But what you have to do in paper 8, so that remember there's 3 parts to paper 8. There's the just looking historically at your company's relative values, doing the ranking model or the regression model, and the third thing is doing this valuation using a target PE ratio. So on paper 8, you have to actually come up with a target PE ratio, which is what you're going to do is take the long-term assumption for your firm's payout, risk-free rate. You might just use what today is. Long-term beta, long-term growth, you get kind of somewhat of a stable PE ratio after the current period of time. So I'm going to give you some examples of that as well. You'll see how that works. But look at this ratio. It's so insightful. Risk-free rate, interest rates. When interest rates rise, PE ratios will fall. That's what this ratio says. And that's exactly what happens. When interest rates are really high, like they were in the early 80s, PE ratios were like 6, 7, or 8. Very, very, very low. Right now, interest rates are really, really low. So PE ratios are in the 30s. That's really, really, really high. Extremely high PE ratios. So I actually think they're getting a little stretched. I think the stock market's getting a little bit too overpriced. But we'll see. Everybody's expecting earnings to come back really, really strongly. But I priced the S&P 500 this last Monday for the Investment Society. And, you know, the current market's within the range, but I think we're getting to the top part of the range. It's getting a little scary. But this is part of reason people argue that the stock market's not all that expensive because interest rates are so low. So when risk-free rate is low, PE ratios will be high. The market risk premium, that's how risky it is to invest in stocks. When that rises, PE ratios fall. And you saw that in 2008. When volatility increased in 2008, you saw PE ratios drop dramatically, just because people were so scared to death. They were demanding a much higher return from stocks, and so the prices fell dramatically. You saw it this year in April and May, March, April, and May, when you saw the stock market crash. That was definitely a large increase in volatility and in risk just overnight. Those two things are related to all stocks. So from a relative value standpoint, we can ignore risk-free rate and market risk premium because all stocks use the same risk-free rate and the same market risk premium. So all PE ratios are impacted by that. So that's not what we're going to focus in on. We're going to focus in on the beta and on the growth. And think of beta as risk and the growth is the fundamentals. Remember I said you need two things in the three things in analysis. You need a PE ratio, you need measures of risk, and you need measures of fundamentals. And that's what we have here. A PE ratio, beta is our measure of risk, growth is our measure of fundamentals. And so when the firm is more risky, firms with high betas will have lower PE ratios. Firms with lower betas will have higher PE ratios. That's why if you look at a firm like Walmart, you look at Walmart and their PE ratio looks kind of high. You know, I don't know what it is right now. I should probably check. But once you adjust for risk and fundamentals, yeah, that's exactly what we're going to do. I just typed Walmart in and waste management came up, and that happens every single time I type Walmart in. So Walmart's PE ratio right now is 23. Boy, that sounds like a high PE ratio, but why is that okay? Well, because Walmart is a very low beta company. You know, it's a 0.6, 0.7 beta company. Some people probably even think lower than that. So it's not that Walmart's this high growth technology company, and that's why its PE ratio is high. No, it's a low risk company. So it has a high PE ratio because it's low risk. And then the other thing to look at is growth. Growth is the only thing where we subtract the number. So the higher the growth, the higher the PE, they go in the same direction. So firms with high expected growth, like an Alphabet's PE ratio, I think, is like 95, 96 or something. Or Amazon, I'm sorry, Amazon's PE ratio right now, I think, is below 100 for a change. That's kind of nice. It's at 97. That's a high PE ratio. Is that because Amazon's a low risk company? Well, no, Amazon's probably an above 1 beta company, but they have high expected growth, and so they have a high PE ratio. So the PE ratio tells you about interest rates. It tells the overall PE ratio of the market, tells you about interest rates, the market's view of risk. The beta of the stock market is 1, obviously, but also tells you about expected growth. When you come to your particular company, the risk-free rate and the market risk premium is the same for all companies, so they kind of drown out. So it's really a focus on how risky is your company and how fast are they growing, so risk and fundamentals. Now you notice I'm ignoring one number, and that's the payout. Why are we ignoring the payout? Well, remember in paper 7, one of the ideas I gave you for coming up with the growth for your company was the sustainable growth model, which says that sustainable growth is ROE times retention. And what that model says is the more a company pays out, the lower its growth will be. The more a company retains, the higher the growth. So finance actually says these two items offset each other. And so we can somewhat ignore the payout ratio. You're gonna have to put an assumption in for payout ratio for your company. I'll help you with that when we get to that. Definitely next week we'll get into that. So we essentially ignore the payout because we just assume these two are exactly offsetting each other. All right, so that's what a PE ratio is. And this, you have to come up with this with your company. I'm going to show you that in your Excel model, especially once you do your forecast, you will have everything you need to do this model. And according to Dr. Damodaran, what you're going to do in paper 8, the reason I added this to paper 8 is based on his survey. He says a target PE 5 years out is the #1 way his students were valuing stocks. And I do see it quite a bit. It is quite popular. So I want you to actually use this analysis. A couple of y'all are in the CFA research challenge. This is something you would definitely put into that research challenge. So I want to make sure you're exposed to it. Also, if you get a job as security analyst, there's a good chance they would expect you to use right off because it's pretty common. It's, you know, there's definitely some flaws with it, and we'll see that. What Damodaran discovered when he asked his students how many use dividend discount or discounted cash flow models, he said a majority of them said they did, but then he discovered they really weren't. They were using a target PE model where they're only discounting a few years of dividends, and then they're using a target PE. And he said, well, that's not really a fundamental model. that's not really a dividend discount model. That's still a relative value model. All right. So I know some of you are like, I don't understand everything he's saying. You're going to understand it when I do the specific examples. So just keep this page, print it out, and put it in your wallet, because I really think it's really critical. And in fact, I'd encourage you to find the formulas for price to book and EV to revenue. With price to book, you have to bring an ROE in here as well. With enterprise value to revenues, you have to bring ROE and margins in as well. But you can figure out these ratios, what they're saying about markets and stocks, stock markets and individual stocks by breaking out the actual mathematics. All right, these are old numbers. I left them in here because I think they're pretty hilarious. So Apple, when I did this chart, Apple was trading at 11. Today, Apple's trading at 36. So, but there was a time, can you believe it? There was a time when Apple, and this was a long period of time. It wasn't like for 3 weeks. There were several years in a row where Apple was trading around 10 times earnings. So you have to pay $11 for $1 of earnings. At the time I did that, Google was trading at 29. Today, Google is trading at 34, so it's only a little bit more expensive. Campbell's Soup, I don't think, is even trading at a PE ratio because I think it lost money. So they don't have it. No, they do have a PE ratio. They're trading at 9 now. We'll talk about that in a little bit. And Amazon's trading at 97. So what does this mean? Well, at the time of this chart, if you bought Apple stock, you're paying $11 for $1 of earnings. Now think about that, flipping it. What we call the earnings yield. So if the PE ratio is 11, the earnings yield is 9%. You just take 1 over 11. What that's saying is if Apple's earnings never grow again, a 0% earnings growth, you'll get a 9% return. You'll just earn 9% every year forever and ever and ever. That sounds like a really good return. And that's assuming they have no growth. Most people are expecting Apple to have some growth, at least, at least inflation or something. But if they had 0 growth, you get about a 9% return. Amazon, you had to pay $295 for $1 of earnings. Now, Amazon's PE ratios come down to 97, not because the stock price has fallen, because the E of the PE ratio has come up so dramatically. And so back then, it seemed like it was justified. Obviously, Amazon's done really, really well here. Google's trading expensive. At the time I did this chart, the PE ratio was of the entire stock market was probably 18 or 19. So Google was trading pretty expensive. Campbell's Soup was trading really expensive. Why? Probably because it's a low-risk company. All right, so why is Apple trading in the 30s now? Well, because it is growing and the stock market loves Apple now. I would have much rather bought Apple back several years ago at 11. It would have been an incredible investment. In fact, we bought Apple back during that time because it just looked too good to be true. We would have liked, if we bought Amazon, we would have been happy with that, but we didn't buy Amazon. It just looked way too expensive for us. We did buy Google back then. So even though it was trading kind of rich, we liked Google and thought it made sense. I don't think we ever owned Campbell's Soup that I can remember, but Campbell's Soup looks expensive. So the question is, let's just compare Apple to Amazon. So this is the question one of the questions you have to ask in paper 8. Remember, there's 3 things. So this isn't the first thing. Just looking at their PE ratios, you're going to assign cheapness to richness. So Apple is definitely trading cheap. Apple is definitely trading cheap on this page. But why is that? Are they trading cheap because they're undervalued? They're really a cheap stock. Are they trading cheap because they're a slow growth company? Are they trading cheap because they're high risk, or is it some combination? Maybe they're slow growth and high risk, but they're still cheap. Why is Amazon trading so expensively? It's because they're overpriced, they're rich. It's because they have incredibly high growth, which is probably the real reason, or it's because they're low risk. I don't think they're low risk. So pretty much for Amazon, it's high growth. For Apple, it was probably the slow growth more than anything else because everybody's really huge margins that Apple was getting. We're going to start collapsing. I remember we had a tech analyst from UTSA come speak to the class back then, and he was a big fan of Apple because he thought the market had Apple's margins all wrong. The Apple's margins were not going to collapse nearly as much as the market thought, and so he was a big believer in Apple. But that's what you're after, and I'm going to show you exactly how to do it again. Trust me, when we see the actual models, you'll know exactly what you're supposed to do with it. But I want to make sure you have a good foundation before you get there. Hopefully you all know that low PE means a cheap stock and a high PE means a rich stock. But make sure you know, why is that? Is it fundamentals, growth, or is it risk or beta or whatever? You know, something related to fundamentals or something related to risk or some combination, or is it your stock just mispriced? All right, so here's the key that you got to make sure you understand this part. I have an exam in my investment class where I ask questions about this, and it amazes me how many students get this wrong. This seems so straightforward and easy to me, and it must not be. It must be one of those things that I've been in the business for 30-something years. It just seems so second nature, just exactly. But I can tell a lot of students struggle with this. So get this into your nomenclature that you understand exactly when to use which ratio, and which ratios are unacceptable at all times. So your numerator is going to be either price or enterprise value. Remember, price is only for the stockholders. Enterprise value is both stockholders and bondholders. Your denominators will be earnings related. The three I'm going to use are earnings per share, which is the price to earnings ratio, the PE ratio, earnings for interest and taxes, and earnings for interest, taxes, depreciation, and amortization. Those are the three I'm going to use. Book value is just your assets minus your liabilities on a per share basis. And then you know what revenue is. So the key is, when do you use price and when do you use enterprise value? Anybody remember from my investment class that wants to explain this? What about EBIT? Anybody remember? I won't call on anybody. Then everybody would go to no video. I see a couple of y'all are in that class, but I won't call on you. Anybody remember? EBIT, should it be price to EBIT or EV to EBIT? Perfect, yeah, it's before interest. So interest before interest belongs to whom? It belongs to stockholders and bondholders, right?
Right.
Thanks, make my night here. So EV to EBIT, why? Because EV is stockholders and bondholders, and EBIT is before interest expense, so it belongs to both the stockholders and bondholders. What if you use price to EBIT? What if you did that? You're going to have a firm that has a lot of debt. And so you're adding all that interest expense back. So your EBIT is really high, but your net income's low because of that interest expense. And you so do price to EBIT, and boy, that stock looks really cheap. Say, man, what an amazingly cheap stock. It's not cheap. The reason it looks cheap is because you're adding all the interest expense back. But then you go to enterprise value, and that firm has a lot of debt, so you're adding the debt back. So you're adding all the debt back. So when you add all the debt back and you add all the interest back, you have a much bigger number here. You have a bigger number here. You adjust it for the debt. Same thing with EBITDA. It's before interest, you use EV. Earnings per share is net of interest expense. It only belongs to the stockholders, so that's why we use price to earnings. All right? Anybody want to guess on book value? Is it price to book or EV the book? Is book value net of interest expense or before interest expense? What is book value? That's your retained earnings, right? What do you put in retained earnings? Do we add back interest expense before we put it in retained earnings? No. So what is book value? Book value is net of interest expense. It's all the earnings of the firm throughout history, but without the interest expense. So there we use price to book. In fact, price to book is one of the most popular ones out there, price to book. All right, anybody want to guess on revenue? Is it price to revenues or enterprise value to revenues? Is revenues before interest expense or after interest expense on the income statement? Any takers? Now y'all are scared to say anything. Since I pick on y'all after you guess. No one, no takers? I can see about 5 people that were in my investment class in here. All right. On the income statement, revenue is before interest expense, so you use EV to revenue. Now, if you go to Yahoo Finance, they have price to earnings, they have EV to EBIT, they have EV to EBITDA, they have price to book. All of those are correct. And they have EV to revenue. All of those are correct. Unfortunately, Yahoo Finance also has price to revenue. That's the one place where they have a mistake. It may not be as serious a mistake because revenue is usually a massive number, and adding back interest doesn't always have that big of an impact. But you should not use price to revenue. You should use enterprise value to revenue, because revenue is before interest expense, so it belongs to both the stockholders and the bondholders. Stockholders don't get all this revenue. They got to pay their bondholders the interest before it belongs to them. All right, questions on that? Obviously, I'm only going to give you the right ratios, so you don't have to worry about it. But I want to just make sure you know this because it's really pretty good stock analyst. The guy I remember I've had people talk to my class that are stock analysts, and they flip back and forth on those things all the time. They talk about the price to earnings, the EV to EBITDA, the EV to revenue. I'll occasionally accidentally say price to revenue because I'm just talking too fast, but the people who are in the business right now doing this every single day, they don't make that mistake. They always say it correctly. All right, so critical that you get these things lined up. Make sure the capital provider in the numerator lines up with the fundamental factor in the denominator. So price to earnings, EV to EBITDA, PEG ratios. We talked about PEG ratios for paper 7 when you come up with growth rates. I'd love to use PEG ratios for the technology sector. I'm going to try. The problem with PEG ratios is you get a lot of NAs, and so it kicks a lot of companies out. And so I might not use PEG ratio. We'll see. Price to book works really well for some industries. We have some industries where their book value has gone negative because they purchased so much of their stock back. What you can do there is just add up several years worth of earnings and just do price to like 10 years of earnings. I actually like doing that. I think that's a really good approach. Actually, what I like to do is price to the median of the last 10 years of earnings, or price to the sum of the last 10 years of earnings. I like using both of those. I think they're really, really good. And then revenue-based EV to sales. And I'll have all of them in here. One thing I think is really interesting is revenue per EV for sales tends to be one of the most popular ones for regression models. So it seems like right now the stock market's really focused on revenues. And so that tends to dominate, even though it doesn't make sense for all industries. It tends to be the one that gets the most play. All right, so those are the ones. I'll probably use almost all of these. One thing I'll tell you on the PEG ratio that you should really think about, I might even try this for tech stocks. The PEG ratio is the forward PE to expected growth in the future. But one ratio, we call this the Jason ratio because I stole it from a guy, a portfolio, a stock analyst, a tech stock analyst. And instead of using the forward PE to forward growth, you can use the trailing PE to actual historical growth and create kind of a historical PEG ratio. So maybe the trailing PE divided by the last 5 years of growth can be a good number. And so I might try something like that because it's a pretty easy ratio to get. But anyway, that's PEG ratio is an interesting one. All right, so here's the next thing. This is where when you're talking about your company, there's certain ratios you want to focus in on. So certain ratios are really good for tech companies. Certain ratios are really good for financials. Certain ratios are really good for retail. So how do you know which one to use? So the earnings-based ratios. Earnings-based ratios are PE ratios, EV to EBITDA, EV to EBIT. Those are your earnings-based ratios. That really works for all industries, but primarily for those that are focused on growth, whether it's revenue growth or earnings growth. So like technology stocks, those kind of new economy type of companies, we tend to use the most popular by far is EV to EBITDA. Because if you think about it, EV to EBITDA, you're adding back a bunch of stuff. And if you're adding back a bunch of stuff, EBITDA is going to be your highest number. So when you do EV to EBITDA, this will be the lowest number up here. So their PE ratio, I can even give you some numbers here. So let me do this with, I'll do it with Apple. So if I look at Apple, Apple's PE ratio, as I said, is 36. Their EV to EBITDA is 22. They don't give us an EV to EBIT. So their PE ratio is 33, but their enterprise value to EBIT is only 23. So they look really cheap. I know managers, portfolio managers, stock analysts that like to use EBITDA, EV to EBITDA because it makes their stock sound cheap. So it's not uncommon for a firm to have a PE ratio of 18 and an EV to EBITDA of 6 or 7. If you're going to your boss saying, hey, I want to buy this stock, and she says, well, what's it trading at? And so it's trading at an 8. That sounds really cheap. If you tell your boss, well, it's trading at an 18, that sounds expensive. Well, the 18 is the price to earnings. The 8 is the EV to EBITDA. You're really lying to your boss unless you tell her, it's an EV to EBITDA. But yeah, that's people like to use EV to EBITDA because it makes their stocks seem the cheapest out of all of them. So it's pretty material. I'm gonna look at Google too because it's pretty fascinating to see how big of a difference there are in these numbers. For Google, they're trading at a PE of 31, and their enterprise value to EBITDA is only 18. 18 sounds a lot cheaper than 31, but it's not. It's the same company, the same valuation. There's no difference. It's just this is which bottom line you pick. So probably for tech stocks, you'll use the EV to EBITDA unless I come up with a good PEG ratio. Then you have book value-based relatives. So for manufacturing, those firms that have high capital requirements, utilities, manufacturing. So those of you doing Deere, Whirlpool, those type of heavy industry, heavy manufacturing, no one's doing utilities in here. Price to book is the most logical one to use. For Exxon and CVX, Chevron and Exxon, you would use price to book. Any type of commodity-based companies, whether it's energy or materials. Ecolab, Richard, I'm not sure Ecolab would use price to book, but you would certainly want to have it in your list to just see. It is a chemical company, so maybe it has some commodity-like feel to it, but I think it's probably going to be more on the manufacturing side. You might still use a price to book because it's manufacturing. And then the last group are those that are focused return on invested capital. Banks, insurance companies, you always use price to book for those. When USAA sold its investment business to Victory Capital, I'm sure they used a price to book like of analysis. It was probably more like enterprise value to assets under management, which is kind of a price to book type of yeah, banks, insurance companies. And it's really interesting, banks. Most of my career, banks traded for price to books of 2 to 1. That was real typical. If you look at a Bank of America today, their price to book's not even 1. I mean, think about Bank of America. Their stock is trading less than what the accountants say the company's worth. Their price to book is below 1. Just amazing. Even Citibank or Citigroup, their price to book is 0.49. Isn't that amazing? Citigroup's stock value is half of what the accountants say the firm is worth. I thought accounting was supposed to be conservative.
And why would that be?
Well, before the financial crisis, they were all well above 1, and most of them at 2. Because of the financial crisis, they've really come down. And I think what the market's saying is these banks still have some really bad assets that haven't been taken care of. So it's interesting. I mean, maybe Citibank is just really cheap right now. I saw some of these getting down to a 0.1 price to book. They're valuing the company at 90% below the accounting value. But I mean, it's a good question. Should you buy Citibank? If you can buy a company for half of what the accountants say when the accountants are supposed to be conservative, it sounds like a really good deal. Now, JP Morgan is probably above 1, but I don't think they're above 2 where they used to be. So yeah, JP Morgan today is 1.24. So they're one of the few ones that are above 1. There are some banks above 2, but it's some of the smaller regional banks that just don't have the asset quality problems. Cullen Frost is an interesting one. Cullen Frost is a huge takeover candidate. Their price to book is above 1, but that's because their loan to deposit ratio is so low. I don't know why the Frost family doesn't just sell out, because they could. It's a really excellent bank because you can get a huge deposit without picking up a lot of bad debt. But they're trading above 1 mainly because of that reason. They're just a strong deposit base. They were 148 just a few years ago, so they've come down some, but they're above 1. So some of y'all will be using price to book. None of y'all have banks and insurance companies, so you won't see that. Then you have relative base. This is pretty simple. All the retail, Costco, Starbucks, I forget what else y'all have in there. Those will definitely be EV to revenue. That's almost the most obvious one. I can't imagine a model not picking EV to revenue for Costco. It's 100% of the time that I've seen it. I guess it's possible something strange would happen. So so that's the most straightforward one. I'll still put them all in there, and we'll let the model decide what's the most important one. And what I think we're going to find with tech stocks is while it's tech stocks should be doing EV to EBITDA, I've seen time and again where the model be the revenue. And just right now, the whole stock market is so focused on revenues. In fact, I've even seen aerospace. You would think aerospace companies like Lockheed would be priced to book, but I've even seen companies like that going on an EV to revenue just because that's the only thing anyone seems to care about. All right, questions here. This is pretty important. And this will define which ratios you talk about in paper 8. You can definitely talk about all of them, and I'll give them all to you, but you probably want to start with the one that's most closely related to your industry. And in fact, with tech stocks, you might ignore PE ratios entirely and only use EV to EBITDA. So we'll see. There's a huge advantage of EV to EBITDA is when I'm looking at 500 companies or 400 companies, since EBITDA is a much bigger number than earnings, with PE ratios, I lose all those companies with negative earnings. With EBITDA, since I get to add back so much stuff, interest, taxes, depreciation, amortization, I take those negative earnings and now they're positive. So I have a whole lot more companies I can deal with. So I probably won't even put PE ratios into the analysis. I'll probably stick with EV. Usually the model doesn't care between PE ratios and EV to EBITDA. So I like to use EV to EBITDA because it gives me fewer NAs when the companies come in. So, but we'll see. We'll see how your model works. Okay, so I'm not hearing any questions. Interrupt me if y'all have them. Dr. Damodaran, he says the main reason it's the most popular is because people like saying EBITDA. This sounds better than price to earnings ratio. There's really no, if you're talking about EBITDA, maybe EBITDA is closer to a free cash flow kind of analysis. I actually think, why don't we use price to cash from operations? If you're going to use EBITDA, why don't we just use cash from operations? That's very similar, right? You're adding back depreciation and amortization. So what's the difference? Well, to me, the biggest difference, and y'all think about this, what's the biggest difference between EBITDA and cash from operations? Where it's that working capital requirement. So EBITDA has accrued revenue added into it, right? So, but cash from operations, it only has cash. So it subtracts all that net working capital requirement out. It subtracts out receivables, subtracts out the inventory. Well, I think that's really important part of liquidity. So I would say if you can use EBITDA, you might as well just, instead of using EV to EBITDA, just do price to cash from operations. We use price because remember CFO is net of interest expense. So actually, Victor, I would argue that price to CFO is a better measure than EV to EBITDA, but it doesn't sound as fancy as saying EBITDA. And yeah, I'm serious. Damodaran said, he actually, I don't think he was joking either. I think he was serious. That's the reason it's the most popular. So a little cynicism there, but and obviously if you're in an interview with a non-finance person, you're going to say EBITDA. Just you just got to impress them. Any other questions on this? I might use it for tech stocks, and I might actually create a PEG ratio that's related to price to CFO relative to the growth in CFO. I actually think that's a really good ratio. I wouldn't use it for banks and insurance companies, which is my field, because banks and insurance companies, their cash from operations is almost meaningless. It really doesn't mean anything. I don't think there really is a free cash flow for banks and insurance companies. They're such different businesses. But yeah, some of these other businesses, especially tech, I really think cash from operations would be my focus. And so if I did that, I'm going to be kicking out Netflix because their cash from operations is negative. So I wouldn't recommend, I can't remember Jacob or Curtis that's doing Netflix. I think it's Jacob doing Netflix. I wouldn't recommend doing cash from operations for Netflix just because you can't. Maybe I'll throw that ratio in there for you. You can certainly get it off of Bloomberg. They do have a price to CFO ratio, and you can pull it in. Maybe I'll bring that in and just see if any industry likes to use that number in their analysis.
So
right.
which one did you say was good for to like take into account net operating working capital? Was that the
Price to book? Firms
okay.
that are focused on return on invested capital, which is bank and insurance companies, they always use price to book. But for your company, for CarMax, I would probably put them down here in the revenue.
Revenue? Okay.
Yeah, they're really more retail than they're anything else. So yeah, I would put them down in that category. We'll see. I mean, we'll run the model and see, but I think CarMax, I'm pretty sure it's going to come out to EV the revenue. All right, any other questions on that? Tuesday, what are we going to do? We're going to actually build this number one thing. We're going to screen for stocks. And you're not actually screening for stocks. That's what we do in the investment society, though. We use these models to get us a buy list of stocks that we like. Some of y'all have done this before. You've been involved in investment society. You know how it works. We're going to do it a little differently for this class. What we're going to do is graph your company versus everybody in the industry. And we'll see if your company is cheap or rich based on that. Now, you probably could do this with bonds. I've not seen someone do this with bonds before, but you probably could do a similar type of model out of Bloomberg and try to find bonds that are overvalued. It's a little tougher because bond pricing is not quite as reliable as stock pricing. You can definitely do it to value non-publicly traded companies. I'm pretty sure that's what USAA did when it sold Victory Capital. I'm pretty sure if USAA were to sell its bank, it would probably look at its, let's see, Capital One. I forget what Cap One is. I don't remember what their ticker is, but they probably look at a bank that's very similar to USAA's bank and look at its price to book, and probably that's how they price it. So non-publicly traded companies, you can definitely use this. You know, if HEB were to want to sell, go public, they would probably look at the price to book of other grocery stores. There aren't too many of them left because Walmart's taken over the world, but Kroger's and whoever else is still out there. And that's how they would probably figure out what their public value would be. You can certainly use it to determine benchmarks for a company, whether it's public or private. I've done that for USAA to let USAA know, here's where you should be on these ratios given where this industry is. And then one thing you're going to definitely notice, we're going to see this next Tuesday night, is you're going to figure out what factors are most important to the stock market. And so you might find that the stock market's allocating 30% to debt to equity. And you say, no, I don't think debt to equity is that important. Well, that's fine. You can reduce the allocation from 30% to 20%. It's going to reduce your R squared because we're trying to go against what the market thinks. So what we're going to do is we're going to run all these factors, and we're going to let the tell us which ones are most important based on what the stock market thinks. And then we'll look at them and say, well, what do we think? And we may change some of the ratios so that we can figure out where we really think our company stands based on what we think is most important. And I'll show you some ways that you can do that, some really simple ways. And again, I'm going to have all this built for you. So I'm doing all the work for you other than writing in papers. So you've got the easier part. All right. So we'll leave it there. I'll stay on if you have questions. If you're behind on your paper, boy, you'll do me a huge favor if you can get your late papers in this next week. Next week is the only week this entire semester I don't have 20 to 30 hours of grading to do on the weekend. So next week's my catch-up week. If you send your late papers after next week, it might take me 2 or 3 weeks to grade them. So don't do that to me. Get them in if you can. Get something into me, all right? After we get paper 6 and 7 out, I'll give you a detailed rubric for all of your papers, and then you can use the last few weeks of the semester to finish up 8, 9, and 10, which are the easier papers, and then fix any paper you want to fix. All right, so that's it for me.